everyone, this is Dr. Mihir Shah once again with another video. In this video we are going to be solving university question paper under the subject Investment and Portfolio Management, also known as IAPM. We are going to be solving November 2024 university question paper. Again, a very important video for all the TYBMS Semester V student. In this particular video, we are basically going to solve all the practical problem sums that had appeared in November 24 question paper. So let us start one by one and let us see what are the questions that had been there in the paper and how to solve them in the most simplest manner. Okay, the very first question number 2C, the security return on stock of Dr. Reddy's lab and Alchem lab under different status of economy are given below. So they are giving you probability, they are giving you stock, the return of stock of Dr. Reddy's lab and return on stock of Alchem lab. They are giving you 4 periods. We have boom, low growth, stagnation and recession. Calculate the expected return and standard deviation of returns on both the stocks and advise to invest in one of them. So we are going to solve one by one. First, we will be taking up Dr. Reddy lab. Okay, so this is Dr. Reddy lab. The columns will be particular probability returns, expected return, R minus ER bar, R minus ER the whole square, ER bar the whole square, and P into R minus ER bar the whole square. Under particulars, we'll note down boom, low growth, stagnation and recession. Probability is given as 0.3, 0.2, 0.3 and 0.2. Returns of Reddy is 50, 45, 30 and 25. Next column, we multiply them. We multiply 0.3 into 50, 0.2 into 45, 0.3 into 30, 0.2 into 25 and we'll get our expected return as 15, 9, 9 and 5. This 38 is nothing but our expected return, which we'll note down later on just to show you that it is the expected return. Next, R minus ER. R is all your return minus your expected return. So 50 minus 38, 45 minus 38, 30 minus 38 and 25 minus 38. We will get 12, 7, negative 8 and negative 13. Next column, the square of this. So 12 12s are 144, 7 7s are 49, negative 8 into negative 8 is positive 64, negative 13 into negative 13 is 169. And lastly, we need to multiply this column with the probability and we get the values as 4.3, 43.2, 9.8, 19.2, 33.8, the total of which comes to 106. That is the total variance. So now let us put into the formula and see what are the various answers that we get. The first thing was expected return. We got a 38%. In order to find standard deviation, we need to find the root of variance, which is the root of the last column, which is the root of 106, which is 10.3. Okay, so we got the return as 38% and we got the standard deviation as 10.3. This is of Dr. Reddy's lab. Now similarly, we'll be solving for Alchem lab. Okay, exactly same way. So just note down, expected return 38% and standard deviation 10.3. Okay, now same way for Alchem lab. Let us see how to solve that. First, we will note down all the particulars. So boom, low growth, stagnation, recession. Then we note down the probability. Same 0.3, 0.2, 0.3, 0.2. We note down Alchem ka returns 45, 50, 40, 30. We multiply them, we get the expected return, so it comes to 13.5, 10, 12, 6, total comes to 41.5. Now next is R minus ER. Okay, so 45 minus 41.5, 50 minus 41.5, 40 minus 41.5 and 30 minus 41.5, we get these values. 3.5, 8.5, negative 1.5, negative 11.5. Okay, the next column is the squares. And lastly, we multiply with the probability. Okay, and the total comes to 45.25. Exact similar to the way how you solve for Dr. Reddy's lab. Okay, so first answer we got is expected return, that was 41.5%. Standard deviation was the root of variance. So the root of variance came to 45.25. We found the root and we got the answer as 6.727%. So now looking at both, okay, return in that case of 38, here it is 41.5, and the standard deviation, when you compare both of them, okay, always remember standard deviation should be less, expected return should be higher. So in that case, Alchem lab is showing much more better prospect. So final answer will be Alchem lab is advisable to be invest. Okay, so you have to choose any one of them. So the returns is higher of Alchem and the standard deviation is lower. So Alchem lab is advisable to invest. So this is how you all had to solve this very first question. Okay, you all can go through it once. Okay, next, the balance sheet of L&T Realty Limited as on 31st March 23 was as under. So they are giving you the liabilities. Okay, they are giving you the liabilities, they are giving you the asset, they are giving you profit after tax, market price and dividend per share. They are asking us to find liquidity ratio, earning per share, price earning ratio, dividend payout ratio and debt equity ratio. So very first is liquidity ratio. Now liquidity ratio का formula is quick asset upon quick liability. Okay, so quick asset mein what are the quick assets which are available to us? We have debtors, we have cash, we have advance salary. Under quick liability we have except overdraft. Okay, so we have creditors, we have outstanding expense. So 3 on numerator, 2 denominators, we add up 1,75,000 plus 45 plus 40 divided by 85 and 155. We get 2,60,000 divided by 1,40,000 which comes to 1.857. That is the liquid ratio. Second, earning per share. First, the formula earning per share is profit after tax minus preference dividend upon number of shares. Profit after tax given 4 lakhs. Preference dividend is taken on preference share. Now preference share is 10% of 3 lakhs. So 10% of 3 lakh is 30,000. So for 4 lakhs minus 30,000 upon number of shares. Here the number of shares is directly given to us as 6,000. So we take it as 6,000. So 4 lakh minus 30 divided by 6,000, we got 61.667. That is earning per share. So these are the first two ratios. I can go through it once. Okay, now next, third, price earning ratio, or also known as PE ratio. Formula is market price upon earning per share. So market price of the share is 230, earning per share we just now found as 61.667. So you divided, we got the value as 3.73, or that is price earning ratio. Next, dividend payout ratio. Formula is dividend per share upon earning per share into 100. Dividend per share is given the question as 30. Earning per share we already found 61.667 into 100, we got the value as 48.65%. So, okay, so you can go through. These are the next two ratios which they had asked. Okay, and the last, debt equity ratio, very important. Debt equity ka formula is debt upon equity. The debt is debentures. I can see here 9% debenture 2,50,000. Now equity is equity fund. So in that, be careful. You have equity share plus preference share plus reserve and surplus less fictitious if there are any. So we had 6 lakh plus 3 lakh plus 1,80,000 minus 50,000. So 2,50,000 divided by 10,30,000, we got the value as 0.243. That is debt equity ratio. Okay, you can go through it once. So with that, we have basically completed this question based on ratio analysis. Okay, so I hope you all have understood this. We'll go to the next one. The information of 3 portfolios of government industries are given below. We have portfolio, Welspun, Sutlej, Raymond and market index. We have average return on portfolio, we have beta, we have standard deviation. Compare this portfolio and performance using Sharpe trend measure, and risk free rate of return is given as 8%. So first we start with Sharpe. So Sharpe's measure का formula is return minus risk free return upon standard deviation. So for Welspun, see, returns are here, okay, beta and standard deviation is here, and risk-free return is 8%. So for Wellspun, 18 minus risk-free 8 divided by standard deviation 0.48. So we got 10 upon 0.48, which comes to 20.83. For Satluj, it will be 19 minus 8 upon 0.38, which comes to 28.95. For Raymond, 22 minus 8 upon 0.28, which comes to 50. And market index, 24 minus 8 upon 0.32, which comes to again 50. So this is how you all have to solve, the portfolios based on Sharpe. So in this, if you have to compare, which one is the better among the both? So market index and Raymond will be ranked as 1 because they are the highest. Okay. Second will be Satluj, and third will be Wellspun. Same way now we need to find for Trenor. Trenor ka formula is return minus risk is return upon beta. Betas are here. So for Wellspun, it will become 18 minus 8 divided by 0.9, which comes to 11.11. 19 minus 8 divided by 1.4, which comes to 7.857. 22 minus 8 divided by 1.1, which comes to 12.73. And 24 minus 8 divided by 1, which comes to 60. So based on this, the highest is market index, so that's 1. Then comes Wellspun, which is 2. Then Wellspun. We have Raymond, which is 2, because that's 12. Then we have Wellspun, which is the third, and lastly we have Satluj, which is 4. Okay, so this is how you all had to solve the sum based on Sharpe and Trenor's measure. You all can go through it once. Okay, now I hope everyone have noted down. We jump to the last sum. The following information, the securities are as follows. They are giving you Archie's, Faber-Castell, DOMS and market return. They are giving you expected return and beta. If the risk-free return is 7%, calculate return for each security under CAPM method and identify the security which are undervalued, overvalued, par, and advise them to invest. So first is Archie's. Now remember, CAPM ka formula is risk-free return plus beta into RM minus RF. So under Archie's, the risk-free return was 7%. RM in the beta given is 1.5. RM is market index or market return, which is 24 minus risk-free 7. So 24 minus 7 into 1.5 plus 7, we get the value as 32.5. 32.5 is our expected, the return that we have found, and expected is 22. So if the return which they are given and is 22 and we are getting 32.5, so our expected returns are too much, it is overvalued. So the answer is overvalued. This stock is very highly valued. For Faber-Castell, 7 plus 1.2 into 24 minus 7, we get the value as 27.4. Given is 21 and it's showing 27.4, so it's much more highly valued, so it's overvalued. For DOMS, it will be again 7 plus 0.8 into 24 minus 7, so which comes to 20.6. Value given is 23 and the value showing is 20.6, so it is lesser, so that's undervalued. So remember, if the stock is overvalued, the investment decision will be to sell. If it is undervalued, it will be to hold it or purchase it. Okay, you buy it. Anything which is undervalued, you buy. Anything which is overvalued, you sell. And third, market index, okay, 7 plus 1.0, 24 minus 7, so it comes to 24. So it's the same value at par. So at par, you hold. Overvaluation, you sell. And undervaluation, you buy. So this is how you all had to solve this particular problem sum. Okay, you all can note it down once. Okay, chalo. I hope everyone have got all the answers of all the practical problem sum. Chalo, with that we will be ending this video here.